Welcome to Debt Matters. Usually when we talk about a medical diagnosis, there is a very specific expectation of precision, right? Like you break your arm, the x-ray shows a jagged white line, and the doctor just points at the screen and says, there is the problem.
Right, it's totally binary. The bone is broken or it's intact.
Exactly. It's binary. And we tend to apply that same, I don't know, desire for binary clarity to economic data and corporate health. We want a clear metric that just tells us, yes, the economy is healthy, or no, it's broken.
Oh, definitely. But when you step into the world of commercial credit and business insolvency, that x-ray machine is, well, it's notoriously unreliable.
Yeah, which brings us to the Q2 2026 UK insolvency data. We are going to unpack what these numbers actually mean for your cash flow, your credit management, and your strategic planning for the rest of the year. Because if you just read the headlines, you might think the patient is completely cured.
Yeah, the headline numbers show business failures, specifically formal liquidations and administrations. They dropped in the second quarter of 2026. They're down by about 9% compared to the first quarter.
Right, which sounds great. On paper, that reads like a definitive win. You might assume lenders are extending grace periods, trading conditions are finally stabilizing, and companies are just finding their footing.
And that is exactly the narrative the broader market wants to project, right? A drop in formal insolvencies suggests that the acute phase of economic distress is easing. But our objective today is to look at the actual mechanics behind those headline figures.
Because when you talk to the people actually managing the ledgers, like the credit managers, the supply chain directors, the debt recovery professionals,
The sentiment on the ground contradicts that data entirely. Confidence remains incredibly fragile. We need to equip you with the context required to navigate what is still a highly volatile environment.
let's start with that disconnect. We have this optimistic headline, fewer companies formally going bankrupt, but the reality on the ground feels completely different. It reminds me of an engine that isn't completely seized up, so it doesn't count as a breakdown, but it's running entirely on fumes and misfiring every few miles.
Right, yeah.
You cannot call that engine reliable. So why is business confidence lagging so far behind this seemingly positive drop in insolvency rates?
Well, it comes down to the vast space between a company surviving and a company thriving. The data tells us they are surviving. They're avoiding the technical threshold of insolvency.
But operationally,
Operationally, the reality is that these organizations are dealing with a convergence of heavy financial pressures. And these pressures don't trigger immediate bankruptcy, but they just slowly drain the liquidity out of a balance sheet over time.
like the structural cost of doing business right now, take financing costs as the most obvious example. A business that took out a commercial loan in 2021 at, say, 2 or 3% is now looking at refinancing that same debt at 6 or 7%.
Exactly. And that is just a mechanical drag on cash flow. I mean, they haven't changed their operations, they haven't lost clients, but suddenly thousands of pounds a month are being diverted just to service debt.
Wow, yeah. And it's not just borrowing costs, right? You have to factor in wage inflation.
Right. Companies are paying more to retain their staff. Furthermore, you have cautious consumer spending at the very end of the chain. The consumer's holding on to their wallet, which slows down revenue generation at the retail level.
And that hesitation just travels all the way up the supply chain.
It does. So the business is squeezed in a vice. The revenue is slowing down because the end consumer is cautious. But the fixed costs, the debt servicing, the payroll, the utilities, they are all higher.
Which creates a severe liquidity bottleneck. Businesses are facing relentless pressure from their own suppliers to settle accounts, while their customers are simultaneously taking longer and longer to pay their invoices. Knowing that this bottleneck exists, how does it physically manifest in the broader economy? I imagine a business owner looking at these narrowing margins and deciding to just halt all forward movement.
That is precisely the behavioral shift we are seeing. Because of this economic uncertainty and the squeeze on margins, businesses are choosing to aggressively hoard cash.
Just keeping the lights on.
Right. They are shelving their expansion plans, they're delaying new hires, they pause equipment upgrades and software migrations. The mandate from the CFO is simply to preserve liquidity at all costs.
I want to visualize this with a concrete example. Let's say we're looking at a mid-sized logistics company in the Midlands. They handle distribution for regional retailers. Their fuel costs have stabilized but remain high, their drivers' wages have increased, and their fleet financing is about to reprice.
Okay, yes.
So they decide not to upgrade their fleet of 10 delivery lorries this year. They hoard that cash instead.
That is a perfect illustration. On a micro level, for that specific logistics company, delaying the fleet upgrade is the rational, prudent decision. It protects their immediate balance sheet.
But macroeconomically,
If we connect this to the macro economy, this behavior fundamentally stalls recovery. An economy relies entirely on the velocity of money, the speed at which a single pound moves from one business to another.
right, because the logistics firm doesn't buy the lorries, which means the commercial dealership doesn't hit its quarterly target.
And because the dealership misses its target, they cancel their contract with the local marketing agency, and they delay purchasing parts from their regional supplier. The velocity of money just plummets.
Everyone trying to save cash simultaneously actually drains liquidity from the entire system.
It is the paradox of thrift in action.
So, knowing that these businesses are avoiding formal insolvency by halting spending, we need to examine exactly how they are staying afloat day to day. If revenues are tight and fixed costs are high, the math still has to balance somewhere.
This is where the Q2 data becomes a bit of a mirage. Are companies actually avoiding insolvency, or are they merely delaying it? The drop in formal failures frequently hides severe underlying financial stress.
Like they're deploying tactical maneuvers that keep the lights on today, but mask structural vulnerabilities.
Yeah, we are seeing businesses act like financial contortionists. They are negotiating informal payment arrangements, essentially pleading with creditors to spread out payments.
Or, more commonly, they are unilaterally extending supplier payment terms, right? Managing cash flow strictly on a month-by-month, sometimes week-by-week basis, just shuffling funds to cover whichever fire is burning the hottest.
And while those maneuvers successfully keep them out of the official Q2 insolvency statistics, they create an incredible fragile commercial ecosystem.
Wait, though. Managing cash tightly, negotiating longer terms, prioritizing outgoings, isn't that just textbook lean management? We often teach businesses to optimize their working capital and hold on to cash as long as possible.
Yes and no.
Why should creditors view corporate survival instincts and aggressive cash management as a red flag?
It is a matter of perspective. For the company executing those maneuvers, yes, it is lean management. But we have to look at the mechanical reality of what they are actually doing. When a company decides to extend a supplier's payment terms from 30 days to 90 days without prior agreement, they aren't actually solving their liquidity problem.
They're simply exporting it.
Exactly that. They are creating a liquidity vacuum. They are taking an unauthorized zero-interest loan from their supplier. They are keeping their own mill running by quietly siphoning water from your pool.
Wow, yeah. And while these are necessary survival tactics for the struggling firm, they inherently increase financial vulnerability across the board.
Because they are operating with zero operational slack.
Oh.
Zero. They have no buffer left. They have maxed out their informal goodwill with suppliers, and they've likely tapped into any emergency credit lines just to maintain basic operations.
So for a creditor, a customer relying on these methods is a fragile customer.
Very. If economic conditions worsen even slightly, like if a single major client of theirs pays late, or if they face one unexpected tax bill, they have no shock absorbers to handle the impact. They will default.
Which proves why monitoring a client's actual financial health is much more critical than simply relying on national insolvency statistics. The national data says failures are down, but your specific customer might be operating on the absolute razor's edge of liquidity.
This reality completely changes the operational playbook for debt collection professionals, credit managers, and small to medium-sized enterprises.
Because when you realize that a large portion of your ledger might be secretly struggling, it leaves absolutely zero room for complacency in debt recovery.
None. Even if a business avoids formal insolvency, they can still destroy your balance sheet if they simply stop paying you on time.
Yeah, late payments are arguably a more pervasive threat to cash flow than outright bankruptcy, specifically for SMEs.
The disparity in resilience is striking. I mean, a multinational corporation might have the cash reserves to absorb a 90-day delay from a major client without missing a beat. But an SME often depends entirely on the prompt settlement of invoices just to make their own payroll and pay their own suppliers.
For a small business, a delayed payment doesn't just mean a temporary dip in profit margins. It can literally mean an inability to operate the following week.
Absolutely. But recognizing that a client is taking an unauthorized zero-interest loan is only half the battle.
Right, so if you are a credit manager looking at an account that isn't technically bankrupt yet, what are you physically looking for on day 29? What does complacency look like, and how do you combat it?
Complacency looks like trusting historical behavior in a changed environment. It is sending an invoice and just assuming it will be paid on day 30 because it was paid on day 30 last year.
Got it. So proactive credit management requires continually monitoring the micro behaviors of your customers.
Exactly. Are they suddenly paying 3 days late? Are they abruptly disputing small, trivial details on invoices to delay the processing time?
Oh, the classic tactic of emailing on day 29 to say they need a different purchase order number on the PDF.
Precisely. It resets the clock. You also need to be regularly reviewing credit limits. This is a mechanical check that many businesses completely neglect.
Let's break down the mechanics of that. Why is an outdated credit limit so dangerous right now?
Because the cost of carrying that risk has changed. Let's say you approved a £50,000 credit limit for a client back in 2024. At that time, capital was cheaper.
So the cost to your business of having £50,000 tied up in receivables for 60 days was relatively low.
Right. But today, with higher interest rates, holding that same £50,000 costs you considerably more to finance. Furthermore, the client's ability to service that £50,000 has likely degraded due to their own increased costs.
Wow, so a credit limit that was mathematically sound 2 years ago might be wildly overexposed today. You're taking on more risk for a higher cost, often without even realizing it.
Which is why maintaining constant proactive communication before debts become overdue is the single most effective tool you have. Early engagement consistently yields better recovery outcomes than waiting until an account is seriously delinquent.
I want to dig into the psychology of the struggling debtor here. When a company's financial controller sits down on a Friday afternoon with a spreadsheet of payables, and they have £80,000 in invoices, but only £30,000 in the bank, how are they allocating that cash?
They are allocating it based on two criteria: the critical path and the squeaky wheel. First, they pay for the absolute essentials required to open their doors on Monday: the cloud hosting, the raw materials, the payroll.
And second,
Second, they allocate cash to the suppliers who are most present and most communicative. If you're actively on the phone, professionally but firmly inquiring about payment, you move up the list.
but if you are silent and just waiting for the automated day 45 reminder to go out,
You go to the very bottom of the pile. The silent creditor always gets ignored.
so how do you avoid being the silent creditor? We need to discuss the concrete preventative actions you can implement immediately. It's like installing a circuit breaker in your electrical panel, right? You want the system to trip and alert you to a surge long before the entire grid overloads and starts a fire.
That is a great analogy. Strong credit management is that circuit breaker against bad debt exposure. To reinforce those financial controls, businesses must establish total visibility over their outstanding debtor balances.
You need a real-time understanding of who owes you what and the exact aging of those invoices.
Because you cannot manage what you cannot see. And when you see an anomaly, you have to act. Chasing overdue invoices promptly is non-negotiable. It also means performing rigorous credit checks on new customers.
Just because someone wants to hand you a large contract doesn't mean you should take it. You have to ask yourself why they're coming to you. Have they been cut off by their previous supplier for non-payment?
That scenario plays out frequently in a restricted economy. Businesses burn through their credit with one supplier and simply move down the street to the next one. It is also critical to agree on clear, documented payment terms before you ever supply goods or services.
Why is documentation so vital in this specific economic climate?
Because ambiguity is the enemy of cash flow. When liquidity is tight, debtors will exploit any ambiguity to delay payment. If your terms are vague or if verbal agreements aren't backed up in writing, you give them an excuse to pause the invoice.
Everything must be documented. Maintain meticulous records of all communications, all promises to pay, and the exact nature of any disputes.
And if that circuit breaker trips, if a client misses a payment, breaks a promise, and stops responding, you need to seek professional advice before a standard cash flow hiccup escalates into a crisis. Engaging a debt recovery specialist early preserves your options.
Because as we look ahead, the economic landscape remains divided. Economists are monitoring two distinct potential paths for the coming months, right? And the credit industry must prepare for both realities simultaneously.
Yes. Let's map those out.
What is the trajectory of Path 1?
Path 1 is a gradual, stabilizing recovery. If inflation continues to cool and central banks begin to adjust borrowing costs favorably, we could see a thaw in that cash hoarding behavior.
So the logistics firm we discussed earlier might finally feel confident enough to purchase those new delivery lorries.
Exactly. Business confidence improves, the velocity of money increases, and the liquidity bottlenecks begin to clear.
That is the optimistic scenario where the drop in insolvency data actually becomes a leading indicator of health rather than a mirage. But what about Path 2?
Path 2 is far less forgiving. If consumer spending slows further or if trading conditions weaken, the businesses that have been running on fumes will face immediate pressure.
Remember the structural vulnerabilities we discussed, the zero operational slack, the reliance on extended supplier terms, the month-to-month cash juggling.
They have no shock absorbers left.
None.
If the road gets bumpy again, those survival tactics will fail. The reduction in business failures we saw in the second quarter could reverse sharply, and we could see a sudden spike in formal insolvencies as those informal arrangements collapse.
To synthesize all of this, the fall in Q2 2026 business failures is a positive metric. It provides a bit of breathing room, but it absolutely does not signal the end of the financial challenges facing the UK supply chain.
It is a temporary reprieve.
Yeah.
It is not a permanent resolution. The underlying pressures of high costs and restricted cash flow are still entirely present.
Which reinforces the core truth of commercial credit. Effective debt collection goes far beyond just reacting to unpaid bills. It is not just about dialing numbers and demanding payment.
No, it is a strategic function. It is about identifying risks early, utilizing your credit limits mechanically to protect your exposure, and ensuring the long-term financial resilience of your own operation.
You must assume nothing and verify everything. Monitor your customers' payment behaviors as closely as you monitor your own bank balance.
Absolutely.
Because there is a profound structural vulnerability hiding behind this seemingly clean X-ray. We have established that large swaths of the commercial ecosystem are currently surviving by quietly extending payment terms, borrowing just to cover daily operations, and aggressively pushing their liabilities further down the road.
Just kicking the can down the road.
Exactly. It begs a rather urgent question for you to consider as you review your ledgers this week. If the broader economy is functioning by constantly deferring its financial pain, what happens to the entire supply chain when all of those hidden, deferred costs inevitably come due at the exact same time? Keep a close eye on those vital signs, protect your cash flow, and don't let yourself become the silent creditor. See you next time on Debt Matters.